Welcome back, everyone. Thank you very much for a previous team. And I'd like to welcome to the stage, all the way down from Fort Collins, CSU RAMS.
14 Colorado State. I'm Drew Bowers. This is Ben Zerl, Noah Cottle, and Ja Rand. First off, we'd like to initiate a buy rating with an applied price of $399.57 with an upside of 50%. Key points today are going to be our new pricing strategy, favorable industry positioning, recovery and lodging, operating margin, expansion, EPS growth, valuation, and risk mitigation. First off, we'll go into our company overview. Vail Resorts is a global company with holdings all over the world, including Australia and Canada, holding the biggest resort in the world, Whistler Blackcomb. Vail Resorts also holds 5 of the top 6 visited ski resorts in the world and is broken down by 3 revenue segments: lodging, real estate, and mountain. A key piece of our project and valuation of Vail is the 20% price decrease in the Epic Pass this year. There's 2 key points to this: increased volume and increased revenue. Vail increased volume by 47% and increased revenue by 21%. This allowed them to expand demographics, increase stable cash flows, and overall have a higher EPS growth this year. We'd also like to touch on Vail's ESG, as this is an important part of investing and something we like to consider more and more every day. Vail has made, in their words, epic promise to, by 2030, have a net zero emissions, zero waste to landfills, and zero operating impact on forests, and continue to have initiatives for communities like every school kids. Now I'll pass it to Ja Rand for industry overview.
Okay, thank you, Drew. So several characteristics in the ski industry actually indicate that Vail Resort is a good investment option as well as a promising company. So basically, the industry is capital intensive and it has a relatively high threshold for the new entrants to compete in this area. Vail Resort, as a big giant in this industry, has good capital ability as well as good brand names. So with the consolidation get rapid, it will gradually even take more market shares in the future. And affordability is the most important factor that prevent people from spending in ski resorts. So Vail Resort is now reducing prices, and now the industry shows a tendency to do the diversification. It is now diversifying its activities and services to attract millennials and non-skiers. So here we can see that the chart on the left shows that the industry is in a position that will see the growth in the next following years. And also the chart on the left shows that the US trips were increasing the following years, which is good news to Vail Resorts because basically 56% of its revenues are generated from the designated travelers. And here we can see that US disposable income will also increase, which will increase people's affordability. Here we can see that since 2014, the consolidation is really rapid, and the Vail Resorts, Altera, and Boeing has made up to 80% of the market shares. Here you can see that from 2017 to 2021, the market shares of Vail Resorts has increased from 45% to 55%. Now I will pass it over to Noah.
Thank you. So I'll be going over the financial analysis for Vail Resorts. So the first thing to note is they have a significant advantage over their competitor, Altera, as Vail Resorts owns many of the largest resorts on their season pass product, whereas Altera does not. So moving forward, they'll have a much easier time reducing prices to drive volume, which will ultimately allow them to outcompete Altera for new customers. So Vail Resorts' debt-to-equity ratio is now 169%, which may seem high, but compared to their peers within the entertainment industry, is much lower. Furthermore, we believe that Vail Resorts has a much easier path to de-lever, as they have trailing 12-month free cash flows currently at $627 million, which they can use to pay down that debt and again de-lever. So again, with the new pass pricing strategy, we're expecting to see much higher free cash flow with this 5-year CAGR projected at 7%. And remember, much of this free cash flow is going to be happening at the beginning of the ski season before a single rider even enters the mountain, which will help mitigate some of that weather variability risk that we're going to talk about later. So as you can see from the chart on your guys' right, monthly RevPAR levels for Colorado ski resorts is up over 20% in December, which is showing that there's already a strong recovery in lodging taking place. And therefore, we're projecting a 5-year CAGR in the lodging segment of 16.5%. Again, helped by the increase in volume. So, because Vail Resorts reduced their pass prices, they're sacrificing some lift revenue growth in the future to drive volumes higher. But we feel this is a positive because all the other revenue segments that typically make up 54 to 55% of total revenue are actually volume driven. So, if you increase the volume on the mountain, those revenue segments will increase as well, which will help increase earnings per share numbers. So last year, they had a serious operating margin expansion up to 35%. But remember, this year they sold 47% more passes. So we expect that operating margin to further increase up into the 40% range and continue a little bit higher moving forward. So all this is going to lead to a record EPS figure supported again by the pass pricing strategy driving volumes higher, which will help accelerate a lodging recovery, which will also benefit all the other volume-driven segments and increase operating margin. So with that, I'll send it over to Ben for the valuation.
Thanks, Noah. Now I'm going to be going over. Thanks, Noah. Now I'm going to be going over the valuation method. So our DCF model implies a price for Vail Resorts of $399.57 per share. We use the free cash flow to equity method because Vail is a very levered business and we wanted to remove the net debt repayments in order to take a more holistic view at the actual value of Vail Resorts equity to its shareholders. So the main reasoning behind our terminal price earnings ratio is Vail experienced an earnings contraction due to the effects of the pandemic, and this sent their price earnings ratio well above 200, almost 260. So as Vail Resorts comes out of the pandemic and their earnings per share number recovers, we think that their terminal price earnings is going to return to a more historical range of between 30 and 60. This, paired with the fact that the Federal Reserve is going to be increasing interest rates, we think that investors are going to be less likely or less willing to invest their money into stocks that have a higher price earnings ratio, as there are going to be other assets that have a similar return with much less risk. In order to test this theory, we ran a sensitivity analysis to test the robustness of our DCF model, and we wanted to use a wide range of inputs into this model in order to test different variations of their price to earnings and their cost of equity. When Vail is compared to its public peers, it reveals their superior revenue and EPS growth year over year and shows their resilience that they had during the pandemic. As you can see, their valuation multiples are similar to these other publicly traded peers, possibly indicating an undervaluation in their shares. Our most bullish case for Vail Resorts is they decrease pass prices again, and this further increases the volume and spreads out sales to the rest of their revenue segments. This would lead to an expansion of their operating margin well over 40%, and we would see much higher revenue and earnings per share, and also Vail taking over more market share from Altera. In the bear case, they would decrease the pass price again. However, this time their operating margin would contract, and they would have less earnings per share and less revenue to go around, and possibly be burdened by the cost of debt. Now I'll pass it over to General Manager for the risk.
Thank you, Ben. So we should also pay attention to the potential risks for well resorts. So basically for the total industry, the most important risk is that the baby boomers actually leaving the ski sports. According to MSAA, for each baby boomers who left the ski sports, it would take 2 millennials to generate the same income as they ski less often and has less spending power. And secondly, due to the huge price reduction, the visit volumes in resort actually has increased a lot, so which caused a overcrowding issue. So also the weather variability, such as delay of the snow season, also cause a potential risks we can see obviously in this snow season. And also since it's internationally traded, the fluctuation of currency exchange rate will also have adverse impact on this. Well, I will pass it over to Drew.
Just to reiterate, we are initiating a buy rating with an implied price of $399.57.
Thank you. Thank you.
So now we'll have 10 minutes of Q&A.
Yeah, I have a question, have the company's operating margins ever been in the 40% plus sort of range? And what sort of changes in the business model do you see post-COVID, specifically in the labor area?
Yeah, so typically they've ranged around 25% up to 30. But again, last year they were 34%, right? And so now they have 47% increase in volume. So that's where we expect it to grow higher. Some labor trends we're seeing, Vail Resorts in their Q1 earnings call earlier this year said they permanently removed $70 million in operating costs. Much of this was from labor. For example, housekeeping, they're no longer doing daily housekeeping, which saves them a little bit on labor, right? So that's where we're seeing the operating margin extension. Just the volume spread over a fixed cost base will help increase the margin.
And is there already supply of labor available to make the beds every day now? And how is that not going to go up with this increase in volume?
Drew, you guys understand about that, right?
As COVID sort of is on the back end, one of the main factors for Vail Resorts increasing their labor supply is J1s. So they haven't been able to have J1s for all of COVID, and this we think will sort of mitigate that risk for overcrowding and increase their labor supply as we're able to bring those people back in from in the J1 region for them. We also think that labor supply will also increase because of the demographic that works at Vail Resorts and ski areas in general, such as people of our age. So, for example, 1,000 employees could be at the community college in Vail, CMC, and they're online, so they're going to go home. But as they come back to school, or as people come back to the resort area, because that's where they want to live, that labor supply should increase.
Yeah, just to add on, so basically, as the COVID-19 impact, so some international workers, such as those people from Argentina and Chile, they are unable to make it to the resorts educational work. That's the reason one. And secondly, during the winter holidays, according to research, require everyone to kind of get vaccinated. So 10% of the employees are out of the workplaces. But we believe that those situations are temporary. So as the operation gets recovery, so the situation is expected to improve. Thank you.
Yeah, I'd like to ask about what you think about Vail's international position. Much of the discussion was on the U.S. market. How are they positioned? You compare them to Altera a lot. Is that a big opportunity for the company in your guys' opinion?
Yeah, so if you looked at their investor presentation from April 2021, they said that 56% of revenue was from destination travelers, right? So that's obviously an important segment. So I think moving forward, as those restrictions are lifted, they'll definitely be able to bring in more people to North America. Do you guys have anything to add to that?
I see a strong upside here. You guys really believe in the stock. My question is, what makes you believe that Vail is really positioned to actually deliver all this growth, right? Some facts that I see, revenue over the last year decreased a little bit. Management has been very concerned about cost cutting, right? Margins even increased during COVID. Recent radical price reduction, let's see if that pays out or not. One of you mentioned that the company has a path to deleveraging. How do you get all of that data and believe that this company can actually deliver on strong growth like that?
I think just in the past, you've seen that Vail is such an innovative company, and they're the ones that started this season pass for resort to resort. And I think other than just the fact that we've given, we just believe in Vail as a company with Robert Katz and the leadership that they have. And I think this year you really see that price decrease take effect. You couldn't really see it during COVID. But now that everyone wants to get outside, everyone wants to do everything after being stuck inside of COVID, you're going to see an increase in travel, increase in people wanting to learn how to ski, increase in people actually coming to Vail Resorts, which is what they make their money on and where they're going to get their volume.
Yeah, and I also want to add, I think that the reason we're so bullish is the way that we projected the revenues for our DCF model. And so we broke down each segment into even more segments, and then took them as a percentage of that segment, so lift as a percentage of mountain, and then projected it out that way. And when we did it like that, we saw really big increases in the lift revenue, and then that's going to drive more volume to the other segments of the revenue as well. And then once we discounted that back, we got the much larger share price increase, and since their earnings per share is going to recover so much and that price to earnings ratio is going to come down, we think that investors are going to be more willing to buy it, and it's going to send the price back higher.
So I have a question just regarding one of your last remarks about the earnings per share growth, how you feel like it's going to have a return to maybe the trajectory it had from 2016 to 2018. When I look at the presentation in Vail's data, it looks like a lot of their growth in terms of their revenue seems rather smooth. Yet you have the earnings per share approximated to, you expect it to possibly increase roughly fourfold between 2021 and 2022. Can you walk me through your thesis behind that?
Sure. So much of the 2021 and 2020 revenues being so low is because of the capacity restraints, as well as a lot of the restrictions on their businesses like dining, lodging, retail, rental, and ski school. But as those come back, you're going to see those earnings per share numbers increase. And again, because of the 47% increase in total season pass sales in terms of units, those are more people on the mountain that will not just ski, but they'll again take lessons. They'll die, or they will dine and they will lodge. And these are very high fixed cost revenue segments. So the more volume that's driven to those is how you're going to get those higher EPS numbers.
But just to follow up. So I mean, I'm looking, for instance, at the lodging expected revenue, and it's like 16.5% growth. The increase in cash flow, free cash flow of the firm, the growth rate there is expected around 7.12%. I can look maybe at some other slides. But again, so where exactly do you see that the EPS is going to really kind of increase by 4? What's going to drive the E there?
So with the operating margin increase, right, the expenses are going to be a lot lower where the revenues are increasing. So the revenues will increase at a lot higher pace and the expenses will increase. And that's why you're going to see the higher earnings.
2 minutes left on questions.
I have a question. How sensitive is their revenue going back to economic recessions? And what are your expectations about that trend and how that would affect?
Obviously, if there's an economic downturn, there will be less disposable income within the market, so less people will be able to afford a ski trip. However, because it is I would say a destination for people with more disposable income in general. In recessions, those people will probably keep their high levels of income, and that's where we feel that Vail Resorts has a chance to survive a negative recession. But also, it's important to remember that they weathered the coronavirus pandemic a lot better than the peers in the entertainment industry. Because through the pandemic, they still had some positive EPS growth compared to their competitors, which had negative EPS growth. So I think that speaks to the resiliency of the business and the strength of their business model.
So basically, just to add something on, so basically, we know that COVID-19 has adverse impact on the resource revenues and its growth. But obviously, we want to remind you that it relatively has a very good position in the industry. So basically, the COVID-19 has an overall impact on all industry, but compared with this, with those small resorts who is now hardly surviving and now more tend to send their resorts to the big gardens, where resorts perform very good, and this asset turnover ratio in the past is around 0.5 to 0.6, but now it's only 0.63, which means that with its operation recovery, its return on equity and its EPS will increase in the future.
Okay, thank you, CSU.
Thank you.